yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present.
President Putin's actions are what is driving the price increase at the pump. The president is focused on doing everything in his power to address the Putin price hike.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Surprise stimulus. Chinese banks cut a key loan rate by a record to boost the economy, while global stocks push higher on the unexpected reduction. No sympathy from the Fed. Kansas City President Esther George says rough markets will not deter the FOMC's tightening plans. Plus, inflation anguish. UK consumer confidence strikes the gloomiest reading since the 1970s after a surge in the cost of living. But defying the gloom, April retail sales unexpectedly jump. So first thing is first, let's check in on the markets, and there has been quite a lot going on volatile. Yesterday, of course, I was in New York speaking to Ken Griffin of Citadel. He does not expect a recession, certainly not in the next 4 quarters, but then all bets are off on what could happen. European stocks, you can see now holding strong, 1.2% higher. Really China's latest measure to try and bolster this economy injected a note of optimism in the end of a pretty choppy week. I'm looking also at pound, 124.68. A lot of the volatility that we've seen is playing out in the currency markets. The Bloomberg US dollar index 1.239. Again, if you look at some of the concerns, certainly in emerging markets and some of the oil producing countries very dependent on dollar, this is where we could see some kind of concern. Bitcoin 30,235. Now, if you look at the European map, and again, it's extremely different if you're on the energy complex and you're sitting in Germany. Maria today spoke to the German finance minister. That's different to whether you're sitting in the UK, where actually you're not that dependent on Russian gas. Also, Treasury yields rising, yields on European bonds as well. The dollar is again holding to its biggest one-day drop since 2020. The CAC 40 gaining 0.8%. The FTSE MIB 1% higher. Now, coming up, we also have a conversation with the BlackRock Vice Chair, Philip Hildebrand, on markets and central banks. So don't miss that interview. And if you have any questions for Philip, you can IB us or even tweet me at Flacqua. Now, U.S. stocks lurching lower as traders wait prospects for growth against a backdrop of rising prices, eroding earnings, and tightening monetary policy. Now, the S&P 500 fell as markets whipsaw today after the biggest single-day drop since June 2020 on Wednesday that actually erased $1.5 trillion from its market value. Investors, however, are still a little bit nervous.
The market's all kinds of in a tither.
This has been a valuation re-rating.
We had a bubble in long duration assets. That bubble is now deflating.
There could be further losses.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks.
We do see a lot of opportunities out there, especially with higher quality investments.
Less about the directional trade and much more about the relative value.
Everything on the fundamental front seems very much intact. 2022 estimates continue to rise.
We have to wait a little bit to see if what the Fed is doing is the right thing.
Everybody's afraid that they're going to get it wrong, and the chances are that they will get it wrong.
I don't think a recession is imminent.
Our baseline is recession late 2023, early 2024.
We're talking about 2024, maybe later.
We don't think a recession is going to happen in the next couple of quarters.
Well, we're now joined by Philip Hildebrand. He's Vice Chair of BlackRock and former chairman, of course, of the Swiss National Bank. And Philip, you've always given me really good chat on inflation. Of course, you believe that it was something, that can't stay here for a long time because a lot of it was imported. Has your view changed on where this inflation is coming from and what it does to consumers around the world?
I think sadly there's not enough of a sort of fundamental analysis of why we have this inflation. And I think we live in a world shaped by supply. We have, of course, more demand than supply, otherwise we wouldn't have inflation. But the real reason for the inflation is that supply is at an unusually low level as a result of the restart post-COVID and the energy shock from the war. So that's the story, and that means you have to be thoughtful as to how you're going to mitigate this inflation by way of policy.
So how should central banks look at this? First of all, is there any question that the Fed is behind the curve?
Well, I think that the key problem is in a world shaped by supply, the way I just described it, you're not going to get a perfect outcome. There's a trade-off involved. Either you have to accept that you're going to have to live with some inflation for some time until these supply problems mitigate themselves, or you have to stamp out demand so much by raising rates so much that you actually drive down inflation. But the price of that is going to be very, very high. And I think that's the part of the debate that is missing.
But you think that's a recession? I mean, if you hike interest rates to a point where you actually deal with inflation, I don't know whether there's an optimum rate for inflation given where we are now. At 4%, do you have a soft landing or do you still have a recession in the U.S.?
Yeah, that's the right question. My sense is the central banks will recognize that they cannot kill demand in order to get inflation down, so they will ease off once they get to neutral. Right now, they're talking very, very tough, and that's what's unsettling the markets. You know, think about it. They were on one side of the boat, completely stuck on this transitory debate, and now they've rushed over to the other side of the boat, talking about stamping out demand in order to get inflation down. So no wonder markets are rocky. In the end, I think there will be a middle path. Yeah. But right now, you know, they're trying to find that place. And what's missing, I believe, is more of a debate as to what is shaping the world right now, what is driving this inflation, and that's the supply story, the unusual low level of supply.
But it doesn't make central banks' job any easier.
It doesn't, no.
In fact, it makes it harder.
It's very hard for them because for the first time in a generation, I believe there's a real trade-off involved. You're not going to get to the Goldilocks outcome where you can kind of, you know, slow demand just enough to get inflation down but not have a recession. This is a different story because it's shaped by supply. And so for the first time in a generation, they're really facing a hard trade-off. So it is a very difficult moment for them.
Philip, what does it mean for markets? So we saw this huge swing actually on S&P. I know it's a bit supported by China right now, but where's the bottom for some of these equities?
Well, I think, you know, this boat analogy is probably pretty good. So they were on this transitory side, the central bank. Now they're rushing over to the other side of the boat. That's rocking markets. As I said, eventually I think the market will find its way once they see what the central bank is going to do. Recession, in my view, is still unlikely in the U.S. Unfortunately, it's probably inevitable or just about inevitable in Europe, given the much greater kind of impact the energy shock has.
But you're not seeing like a hurricane whilst the boat tries to go from London to New York, right?
I think in the short term we're going to see volatility here. The market is trying to find its way. You know, central banks should normalize. There's no question about this. Once they get to normalization, it's a different story. I understand why they talk tough. Yeah. What's missing, I believe, is more of a focus on the real reasons for this inflation, and that's the unusually low level of supply.
Okay, where's this terminal rate? I mean, this elusive terminal rate. Can we actually find it, or?
I believe that in the end, this interest rate cycle will still end up being much more modest than what inflation currently would imply. You know, we'll see. Right now, that's not what they're saying. If you look at the way the market is pricing the terminal point of this cycle, it's still pretty modest relative to history, relative to where inflation is currently. So the market isn't entirely buying the story, even though certainly the equity markets day by day are reacting very much to this very hawkish tone that we're seeing from the Federal Reserve in particular.
Philip, thanks so much. Philip Hildebrand stays with us. Now, coming up, we're also back in Bonn, Germany, where we speak with the Bank of Italy Governor Ignazio Visco. That interview is next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn our attention back to Bonn in Germany, where G7 finance chiefs are meeting for a second day. Well, Bloomberg's European correspondent Maria Deo is at the summit in Bonn, and she's joined by the governor of Italy Central Bank, well, the governor of Italy Central Bank, Banca d'Italia, Ignazio Visco. The words aren't coming out, Maria. Take it over.
Well, thank you, Francine. From one important Italian to another important Italian, Ignazio Visco, thank you so much for joining us at this G7, the head, of course, of the Italian Central Bank, Banca Italia. For the past 24 hours, the word that I hear the most here is inflation, and this need perhaps to adjust monetary policy and normalization. Those two words come out a lot. When you look at normalization, what does it mean for you at the Bank of Italy?
Well, first of all, good morning. And secondly, well, I think we should start by recalling that we fought in the past years several risks. The risks of deflation and the risk of the pandemic generating a permanent recession. And we have been able to successfully counter these risks. Now, how did we do? Well, we did this introduce a set of unconventional monetary policy measures, one of them being having official interest rates in negative territory for a long period. Now, I think that we can move out of this negative territory for various reasons. On one side, demand is back really, even if not as high as it was before the well, it is more or less at the level that it was before the pandemic started, but also inflation expectations are now at around 2%, and apparently they are going to stay there. And therefore we can move, and we can move gradually, raising interest rates in the coming months.
And when you say we can move gradually, what does gradually mean to you? Is it June, July? Maybe it's not the time to put a specific month on it. What does gradual mean for you?
June, certainly not, because in
Out
June,
of the question.
In June we are still purchasing assets for our APP program, and we will end it. But clearly we also have stated, even if we are not prisoners of our forward guidance and so on, but we have stated that we will move after that. After means perhaps July, and gradual means, in my view, that we have to understand that we should move without creating uncertainty in the market. Obviously, there have been many voices in the last few weeks, and I try really to refrain from intervening too much. But I think that we should consider very carefully what we should do on the basis not only of the data, but also of the assessments, the analytical assessment that we can provide. So we should move gradually along a path which on which we really have still to decide where to settle. It is not obvious where. When, it depends very much on the state of uncertainty. We are living in a very, very high uncertainty now because of the various events, and certainly the most dramatic one being the invasion of Ukraine from Russia. And we have to be dependent on the data and on the analysis. We will move, I think we should move gradually around that.
And you make a very good point saying focus on the data, but when you hear other voices that now say, well, it's 50 basis points, perhaps we can do it even faster than we thought. Is that actually a good idea to perhaps talk so much, so aggressively without new data?
Well, this is something that I've been repeating also in the Governing Council. I prefer things being discussed in the Governing Council rather than taking place in this way. On the other hand, I mean, we are obviously free to say what we think most appropriate, but then we have to look at the euro area at large. There are certain issues that clearly we have to take into account. We have to avoid inflation expectations getting disanchored. We have to avoid a wage price spiral to start without really knowing how it will end. We have to understand that we, differently than the United States, we don't have excessive demand pressures. We have substantial cost push from energy prices that started for the geopolitical tensions last year and ended up becoming permanent rather than temporary, as we were saying, because of the Russian invasion of Ukraine.
And sir, can I ask you, when you say anchor these expectations, can the market trust that the ECB will anchor inflation expectations, that you can do it, you're in a position to do it?
Yeah, I think they trust that. As a matter of fact, we are having now inflation at 6-7%, and inflation expectations are around 2%. Medium term are the ones we look for, and they have to trust, because we are really fighting the risk of inflation. even if there is this nonsensical distinction between the hawks, the doves, and so on, I think all the Governing Council members clearly see that inflation above 2% and so on cannot be a permanent feature of our economies. We have learned it in the past. There are risks, but the major risk is that the purchasing power losses that are taking place because of the rise in energy costs may be considered to be met by monetary policy. Monetary policy really has to avoid second-round effects, has avoid excessive demand pressures if they materialize, but the cost push has to be countered in a different way. On one side, there is a loss that we have to accept the economy at large because this is an external shock.
Yeah.
On the other, there might be some redistribution effects that can take place on the part of public finances.
And on that note, the forecasts for you say are always important, but we're seeing some big divergence between the forecasts and the real numbers that come in. Why is this gap, and is there a way to perhaps adjust it and come more in line at the Banca Italia?
We do not have a crystal sphere that we really can. We do not predict the future. We may forecast, we may project on the basis of assumption. One was clearly wrong, and that was the.
And you say that it was wrong.
The absence of the bottlenecks that were visible around the mid of last year. We probably should have considered that the push from, for example, fiscal expansion in the US might have generated high demand pressures, and that was missed. Now we see the risk again of a second bottleneck if you look at the zero COVID policy effects on the part of China in the transport of intermediate goods, and which is really causing another constraint on the supply. But as far as the oil and gas price increases, well, we consider them to be temporary.
Okay.
Is it a mistake? Well, basically, we did not predict the war. Should we have predicted it? I don't know. We certainly do not have. We should organize ourselves better, also in trying to understand the geopolitics of things. But clearly, we didn't think that would take place.
Well, and of course, you're keeping all of that in mind, you say, and going into the future. Mr. Visco, thank you so much for your time, for your time here at this G7. And of course, enjoy the rest of the day. I know the talks continue here, and we wait for the final press conference. Thank you so much for joining us.
It's a pleasure.
Francine?
Maria, thank you so much. Our European correspondent with Governor Visco of Banca d'Italia saying that we must avoid wage price spiral. He's also saying that it's not obvious where the interest rates will settle. July is perhaps, he believes, the right time to start rate hikes. Now, coming up, we speak to the BlackRock chair, Philip Hildebrand, on all things markets. We'll go back to that Visco interview. We'll talk about the European economy. This is Bloomberg. Now, Philip Hildebrand, the vice chair of BlackRock and former chairman of the Swiss National Bank, is still with us. And Philip, we were listening to the interview that Maria Tadeo did with Governor Visco of Banca d'Italia, where he's talking about wage spiral and the fact that that's maybe one of his main concerns, that once that starts, it's even harder to deal with inflation. Can the ECB really raise rates in this kind of environment?
I think they can. They should normalize. There's no reason why they should remain where they are today. But he also made it very clear there are no excessive demand pressures. Yeah. And I thought very interestingly, he said that, you know, we're not yet at pre-crisis level of activity, which again makes this point that this is a supply story. And so therefore, I believe what's going to happen is gradual normalization, plus the economy is going to slow down. We'll probably head into a recession, technically, and that should take off quite a bit of the pressure. So I think it's quite unlikely that we start to see a kind of wage demand spiral taken off.
I mean, we're close to parity, actually, euro-dollar. What does if we touch parity, how problematic is this for dollar? for the U.S.?
Financial conditions are tightening. There's no question. You're going to have higher interest rates. The economy is slowing in the U.S. I don't think it's going into recession, but it's certainly slowing. And so the combination of financial conditions, the currency in particular, rates going up, the tough talking, and the economy slowing down, I think is going to take quite a bit of that pressure out. So we should be at peak inflation at this stage and start to see that ease off.
All right, Philip, thank you so much. Phil Hildebrand stays with us. We'll talk a lot more about the UK, and maybe we'll touch on China as well. Coming up, we continue the markets conversation with the BlackRock Vice Chair, Philip Hildebrand. In the meantime, if you look at stocks, they're actually a little bit supported by what China announced this morning. So we've had a volatile week with the S&P 500 losing the most also in 2 years. That was Wednesday. Now we're seeing U.S. futures rise, European stocks rise. Again, this is after China's latest measure to bolster its economy injected a note of optimism at the end of another pretty volatile week for global markets. Next week, it's also Davos, the summer Davos. I don't know how we'll cope. We'll talk about that. This is Bloomberg. Surprise stimulus. Chinese banks cut a key loan rate by a record to boost the economy. Global stocks push higher on the unexpected reduction. No sympathy from the Fed. The Kansas City president, Esther George, says rough markets will not deter the FOMC's tightening plans. Plus, inflation anguish. The UK consumer confidence strikes the gloomiest reading since the 1970s after a surge in the cost of living. But defying the gloom, April retail sales actually unexpectedly jumped. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're also always keeping an eye, of course, on geopolitics. President Biden on his tour in Asia, just arriving in South Korea. Now, this is, of course, one of the key allies. The war in Ukraine has preoccupied much of Washington, and I have to say it's taken up most of the president's time. I guess provocations from North Korea have also intensified. China continues flexing its economic and military might, which is why this visit it's so important to show his top partners that he also wants to focus eastward and westward. So we'll see exactly what the president's message to South Korea is. This also comes amidst heightened and growing anguish over possible North Korean missile tests. Now, back to the economy and back to the markets. Stagflation, recession, and economic uncertainty are big themes that central banks around the world are grappling with. Now, here are some of the leading voices weighing in on central bank policy.
What is unavoidable is stagflation. I would take actually the approach of Andrew Bailey at the Bank of England. I would be brutally honest.
I'm afraid the one that I am going to sound, I guess, rather apocalyptic about is food.
And the Fed is finally catching up to developments on the ground.
It's been very difficult for households, obviously. Gas prices have been extremely high. Food prices are high.
It was avoidable had the Fed not stuck to its transitory inflation characterization.
Things are so uncertain in the economy right now, it's very difficult to think about trying to give guidance out into the future. Inflation is coming down. That's what we really need to see.
As inflation comes down, hopefully some of those prices will revert and they'll come down.
We're back with Philip Hildebrand, Vice Chair of BlackRock and former Chairman of the Swiss National Bank. So, Philip, it's great because you, of course, understand both worlds, the worlds of investments and the worlds of central bank. When you look at some of the concerns out there, so we had a conversation with Mohammed El Arian, and he was saying, look at the Bank of England. They're so brutally transparent that actually that's the only way that central banks can operate in this kind of environment. But the UK has even a tougher job to dealing with this growth versus inflation concern than other G7 central banks.
They were the first ones to raise rates very quickly. They're also the first ones to openly acknowledge that there is a serious trade-off here. In a world shaped by supply, you know, if you raise rates aggressively, you're going to hurt the economy. You're going to have to hurt it very much in order to get inflation down. So I think that's what they're saying. I think the UK is a special case because we have underlying fragility as a result of the post-Brexit environment, which is not much talked about these days, but that's still very much part of the feature. So that makes the governor's job even more complicated.
What does it mean for fiscal policy? So again, we come out and often we talk about inflation and forget that it's 2 years of COVID, which means that a lot of the readings were off, but also we had this huge amount of stimulus that could have helped with inflation, but also, of course, helps with, large pieces of the population that really need the support.
Yeah, I think for the first time in human history, we were able to basically bridge a global pandemic or a pandemic generally by way of fiscal support in various ways. Different countries chose different ways to do it, but that's a unique thing that's never happened before in human history. We're going to have to kind of bear the cost of that with much higher debt rates, which means going forward, fiscal policy is going to be constrained. That's why there's so much focus right now on what happens on the monetary side.
Where do you see the biggest dislocation in the markets? I mean, we're talking, in the break about the bond market. Like, when you look at the move in certain parts of the bond market, like, if you put that in perspective, it's huge swings in the last 20 years.
It is. The correction is unique in history, right? So 94 is the famous bond massacre. Well, what we've just seen is twice the magnitude in terms of the correction. And that shows that, of course, this is a very significant paradigm shift from basically a multi-decade bond market rally, very kind of structural decline in yields, and that has now reversed. We're heading into a world of higher inflation. I think it's very likely that as we look at the next 5-6 years, we're going to have higher inflation rates than what we've had for decades. So this is a very significant change with vast implications for portfolio construction, for the bond market generally. And remember, most people have never traded bonds on the short side. I always joke at BlackRock, Larry Fink is probably the only person at the firm today who ever traded a bond on the short side, and only just in terms of the timing. So this is it's a real change in paradigm that we're witnessing.
What does that mean? That we could have huge price swings, huge, again, dislocations? Is there a worry about liquidity actually being available in parts of the market?
No, the good news, I think, the way I look at the financial markets, unlike 2007, if you kind of exclude Bitcoin and that part of the markets, the banking system as a whole, to me, looks pretty balanced. I don't see any major imbalances in the financial system outside of Bitcoin, and that's very good news. So I think the markets and the system, the financial system, certainly will be able to cope with this. The markets, of course, have to find a new equilibrium. Again, this is a major shift in the bond market, and equity markets need to figure out where are the central banks really going to end this tightening path. The rhetoric right now is very, very tough. As I said, they've gone from one end of the boat, one side of the boat on transitory, to the other side of the boat in a rush on over-tightening. It's going to take some time for things to settle.
What's your take on a possible recession? And actually, if there is a recession, we often don't define what kind of recession we could be living through.
I still think it's unlikely in the U.S. unless the Fed really decides to hammer the economy, which I believe would be a mistake because this inflation is driven by a world shaped by supply. Now, the risks of that have gone up. So I think the risks of a policy error are up. There's no question. Nonetheless, I believe a recession is unlikely in the U.S. Sadly, in Europe, it's just about inevitable.
What's your take on China? Is it an economic force for good, or is it a danger of policy mistakes?
We'll see. I think what they're grappling with is it was completely unrealistic to think that there is no trade-off between a zero-tolerance COVID policy and the economy. And the target of 5.5% was completely unrealistic, which they've now, in a sense, acknowledged by this aggressive easing step today. So I think they're going to face two choices. Either they have to depart from the zero tolerance COVID policy, or they have to significantly stimulate the economy if they want to be anywhere near the official target, which continues to be officially at 5.5%, which in my mind is unachievable at this stage.
Philip, when you look at all the markets and actually all of our discussion, where are the havens? So I want to ask you, if you look at Swiss franc, yen, does it still fill the purpose that they used to?
Very difficult, right? These certainly the Swiss franc is a limited liquidity currency, so it has safe haven features clearly, but as you can see in this environment, it can kind of accommodate these massive shifts. And in fact, one of the things we're seeing is the kind of breakdown of normal market correlations. It's not like you're running out of equities and can run into bond markets. And so I think that's one of the things that investors are grappling with. If you want to reallocate, where do you go? And one of the features of what we're observing, and I think it's linked to this point, is that we haven't actually seen very significant liquidation in terms of flows. So clients recognize that the normal instincts of going from bonds to equities or vice versa aren't working. We're going to have a year where certainly the bond market is going to be down on the year again. We'll see about equities. So that makes it very difficult to make asset allocation shifts. As a result, we're seeing less outflows than one would have expected when you look at price movements.
We're just looking at President Biden there, who also has to grapple, I guess, with a higher dollar, which is something that we were mentioning before. It's a 6-day trip in Asia, and this is the first, of course, stopover in South Korea, a strategic allies. I'm sure they'll discuss China and North Korea. Philip, when you look at, I guess, the correlation, as you were saying, between equities and bonds, will we ever go back to that more normal kind of tracking of the two?
I think eventually we will. The next 5 years, let's say, are going to be a complicated world because we have to cope with very likely a much more fragmented world. It'll still be global in some ways, but in a different way. We may have different camps. Trade is going to flow differently. We've peaked in terms of globalization since 2007. It's kind of been a sideway movement. We're going to have rebuilding of supply chains, more resilient. We have sustainability coming into this as a big cost factor. So I think it's quite likely that we're seeing for some years higher levels of inflation. Again, I think we're at peak inflation, but it'll settle at a higher level than what we've seen before. Much more fragmentation, less focus on efficiency, more on resilience. No. So I think markets have to cope with some very fundamental shifts in the way the global economy works. And on top of that, we're very likely to have geopolitical tensions going forward for some time.
Being on a Formula One track for the markets.
It's difficult, and I think resilience of portfolios will be the name of the game.
All right, Philip, thank you so much, as always, for your time. Philip Hildebrand there, Vice Chair of BlackRock and former Chairman of the Swiss National Bank. Now, also, the German Finance Minister, Christian Lindner, has told Maria Bloomberg it's key to get inflation back down to 2% to reduce pressures on prices. Now, Lindner spoke exclusively to us on the sidelines of the G7 Finance Ministers meeting in Bonn, Germany.
It is inflation. In the long term, we need sustainable growth for all of our economies. We have to rehabilitate growth in a sustainable, inclusive way. It's a long-term project. We have to finance transitions to a greener economy, digitalization. We have these special challenges for mankind. But in the short term, we have to deal with rising inflation rates. This is, I think, it's key for our economies that we reach again the level of 2% inflation rates. Now we have to take tough decisions. On the one hand, the central bankers, and on the other hand, the governments with their fiscal policy measures. I'm in favor of a neutral fiscal stance. We have to maintain a stable macroeconomic environment. And I suggest to focus on the supply side of economic policies, which means not to pay subsidies and subsidies and subsidies, but improving the surrounding, the ecosystem for businesses, invest in education, research and development, to have productivity progress and not effects on the price level, which is already very high.
So kind of your message is that inflation as it stands for you as finance minister of Germany is not acceptable.
Not Germany. It is for all G7 member states, all G7 countries, a key priority to fight inflation with tough decisions. But in first instance, it's a responsibility for the central banks. And then we have our approach as governments.
German Finance Minister Christian Lindner, they're speaking exclusively a little bit earlier to our Maria today on the sidelines of the G7 Finance Ministers meeting in Bonn, Germany. Now coming up, Richemont's Record, the maker of Cartier jewelry, sees the most growth sales since 1995, but the share price is significantly under pressure. Now we'll be joined by the founder of Yoox Net-a-Porter, Federico Marchetti, to discuss luxury market trends. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Richemont reported full-year earnings that saw operating profit for 2022 more than double compared to 2021. But the luxury maker dampened its outlook with a bearish China forecast. Well, Bloomberg's Laura right now has been across the results. So, Laura, what are the key takeaways?
Well, Francine, this is a China lockdown story. 40% of Richemont's store network in China remains closed. The chairman stating that operating in China in the current environment, it's like having a black tie dinner party on top of a volcano. Richemont now trading down some 9%, and we're seeing a read across with other luxury names such as LVMH and also Hermès. In terms of the division space, it was a beat on sales growth across 3 of the 4 divisions: jewelry, watches and other. Jewelry is still the largest contributor to overall revenue, and jewelry businesses such as Cartier, Van Cleef & Arpels, they've actually benefited from LVMH's acquisition of Tiffany's because it stimulated overall demand in the market, therefore being beneficial for Richemont. There is robust demand for luxury timepiece watches, and in fact the US is now the world's #1 importer of Swiss luxury watches, overtaking China back in October of last year. Leather and fashion comes under other brands such as Chloe and Dunhill. Strong performances there. It's interesting with online. Richemont have struggled to generate profitability with their online business, Yoox Net-a-Porter. No news on a potential tie-up with Farfetch. Reports stated Farfetch may take a minority stake in Yoox Net-a-Porter. So disappointment from the market not to hear anything on that. And a quick note, Francine, I've taken a look at sales on a normalized basis over the last decade for brands such as LVMH, Kering and Richemont. Yeah. And what it shows us is that brands with a focus on leather and fashion, they've been able to outperform. But overall, these companies, they don't have supply chain issues. They've been able to increase prices already by 4 to 5%. Focused demand on local domestic audiences after the pandemic. But China aside, no sign that pent-up demand is diminishing in the medium term.
All right, Laura, thank you so much. Laura right there with some of the numbers from Richemont. Now, we're now joined by Federico Marchetti. He's founder of Yoox Net-a-Porter Group, the world's first lifestyle and e-commerce destination. He's now also chair of the Sustainable Markets Initiative Fashion Task Force. Federico, thank you so much for joining us. I have so many questions on, first of all, how difficult it is to build a kind of a global e-commerce platform, giving all of the different variations here.
Thank you, Francine. I think the point is that e-commerce is such a complex business on behind the scene that to put together different companies is not an easy task. And for example, when I did the merger with Net-a-Porter, it took many years then in terms of culture, technology, migrations. So I think it's just a very complex business to make it profitable and to make it sound together.
Federico, how is the market for fashion and luxury actually changing? I mean, this brings huge money. It's extremely popular, but you don't have the Chinese consumers anymore. You have a lot of, I guess, question marks over the Russian buyers. How do you think it will change and replace what we used to know 10 years ago?
I mean, as you know, I left the Yoox Net-a-Porter in July 21, so it's almost 1 year after a long ride of 22 years, because I founded it in 1999. And I decided to move to sustainability, fully on sustainability, which is one of my passions since 2008.
Do you miss running the company?
No, I don't miss it, especially during these times.
Sustainability is also extremely important because it's one of the I guess, least sustainable industries because of the way we do leather and things like that. What are the concrete actions that your world, the fashion and luxury world, can do to be more sustainable?
Yeah, I've been asked exactly 1 year ago by the Prince of Wales, His Royal Highness, to lead and to chair his fashion task force within the Sustainable Markets Initiative, which is a big organization that he launched in Davos that basically wants to bring the big businesses into sustainability in an accelerated way. And 1 year ago, I gave the Fashion Task Force that I'm honored to chair a couple of visions of the future of fashion. You asked me about where fashion is going. And in terms of sustainability, obviously, I'm a tech entrepreneur, so I wanted to bring technology and innovation into this task force. And the first one was a digital passport, and the second one was regenerative agriculture. And in the last 12 months, we have launched the digital passport at the G7 in Rome. And so all the brands, all the members of the task force, they are rolling out an implementation plan of a digital passport. And the second one that we have just launched is the regenerative agriculture.
And Federico, I mean, what you're very good at, because you're a businessman and you have this background, is of course getting things done. The framework is strong, but unless it's mandatory, are you concerned that actually companies will say, oh yeah, maybe I'll sign it, but I won't really do what I need to do to become more sustainable in 5 years?
No, it's a good point. I mean, as an entrepreneur, I love action and not talking.
Talk.
No.
Yeah.
And that's why I gave two precise objectives to the task force. And the methodology, the way we work is first we get the commitment and then we do a concrete action. So on the digital passport, commitment by all the brands, and then a steering committee that is following each brand, tracking all the brands' roadmap in terms of the implementation of the digital passport. So nothing is left on the air.
Okay, so you'll come back in 6 months to tell me success, right? Or not? Because
I think so.
In 6 months, we'll know more about who signs?
Absolutely, absolutely. But they have already all of them have signed, and all of them are working. It's just a question of the timing, the implementation. And I think by the end of the year, we'll definitely see the first results.
Okay, implementation is so important. Federico, thank you so much for your time today. Federico Marchetti there, the founder of Yoox Net-a-Porter Group and chair of the Sustainable Markets Initiative Fashion Task Force, and we'll hold him, of course, to that and get him back shortly. Now, coming up, Citadel founder and chief executive Ken Griffin gives us a glimpse of his thoughts on the U.S. economy. He takes a less bearish stance on recession risk. That exclusive interview is next. This is Bloomberg.
Yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. We don't know what causes recessions to start. We know the ingredients that create the kindling wood that allows recession to happen, but what actually is the tipping point's often unknown.
Citadel founder and chief executive there, Ken Griffin, talking about a recession. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine, and happy Friday.
Happy Friday.
SpaceX has reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. According to the website Insider, the company made the payment to a flight attendant who worked as a contract employee on the SpaceX corporate jet. Musk calls the accusations utterly untrue. Now, EDF's flagship nuclear plant in the UK will cost more than expected and take longer to complete. EDF now expects the 2 reactors at the Hinkley Point C plant to cost between 25 billion and 26 billion pounds. And that's your Bloomberg Business Flash, Francine.
Leanne, thank you so much. Happy Friday, everyone. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Kailey Leinz, Anna Edwards. This is Bloomberg.
Even though the market has revalued itself, it may have to revalue more because the E part of the PE ratio is going to come down.
Financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future.
Companies that can think about what their exposures are and how to hedge those and where they do have pricing flexibility or power, those are the ones that are going to survive.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, May 20th. Our top stories today. Beijing gives the markets a boost. U.S. futures and European stocks are up after Chinese banks slash a key interest rate. Joe Biden in Asia. His first trip there as president will be dominated by talk of security and semiconductors. And more aid for Ukraine. G7 finance ministers agree on a $19 billion package of assistance for the Ukrainian government. Hours before that, the US Senate gave final approval to a package worth more than $40 billion. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, something certainly coming to the rescue to rescue market appetite for risk assets, or rescue us if you're long at the market at least. Yeah. And some of that coming through in the Chinese session.
Absolutely. You can thank policymakers in China for a lot of the positive sentiment we are seeing come through to end this weekend, although it could still be the 7th straight week in a row of declines on the S&P 500, the longest losing streak since 2001. So we have to keep the week in its entirety in mind here, but it is a more positive end to it, at least it looks like at this point. It was definitely a positive end to the week in Asia. You had Chinese banks cutting the 5-year loan prime rate from 4.6% to 4.45% in order to shore up the economy. The thing is, economists expected that a cut was coming, but they thought it would be in the tune of 5 to 10 basis points, and what we got was 15 basis points. So a positive surprise on that front. That lifted Chinese equities by about 2%, and of course, those Chinese tech stocks, as measured by the Hang Seng Tech Index, was up nearly 5% overnight. You were seeing some of that positivity, more positivity around the China growth story, rippling through other asset classes as well, including the Chinese yuan, one of the big outperformers in Asian FX, stronger against the dollar by about 0.6%, trading right around that 668 level. And finally, iron ore, of course, benefits from better Chinese growth because it means more demand for that commodity. You saw that reflected in those futures in Singapore overnight, up a little more than 5%, trading right around $133 a ton, Kriti.
Yeah, Kailey, that risk-on sentiment over in Asia, kind of feeling over into the United States as well. You can see futures up 1.1%. Remember, we did turn or close the day yesterday in a lower session, so you do see the S&P 500 futures rebounding just a little bit. Some of this is simply going to be a function of that volatility, the green one day, red next day, and then green again. And remember, look, this is a cross-asset dynamic, so you are seeing the 10-year yield up by about 3 basis points. So once again, yields higher, suggesting perhaps of a little bit more risk-on appetite. Here's where it gets tricky, though, because if you look at crude futures, they are down 0.5%. This is important as we talk about the global growth story, and not just whether or not we're going to hit recession, but whether or not refining capacity can actually be catch up in time to this extremely strong growth that you're seeing. And that's the dynamic that's starting to weigh on the commodity market, specifically for oil here. So we're going to keep an eye on that for you. For now, down 0.5%. And just to kind of cap it all, the risk sentiment, our classic risk sentiment indicator, Bitcoin down about 0.2%. A marginal move for Bitcoin. Let's see if that turns around as we get some more green on the screen today, Anna.
Yeah, what does that move lower in Bitcoin tell us in terms of sentiment then, Kriti, given this is the sentiment we have in Europe right now, unashamedly positive. A little bit of this is catch up with the US at the latter part of the trading day yesterday. Some of it is reflecting the news out of China, but something has turned the market mood around for this Friday, and we are moving higher. The CAC 40, the Xetra DAX and the FTSE 100 all posting pretty strong gains. And actually, to get to Kriti's point about lower oil prices, despite that, we have some quite strong buying of energy stocks, and that is one of the things that is lifting the London market. Nearly every sector is in positive territory. There is one here in Europe that is not, and that is consumer products and services. And that sector is down by 0.7%. And this is the reason why. This is Richemont, the Swiss luxury giant, the maker of jewelry and expensive watches and the like. That company down by 11.4% today. The numbers coming through, but it wasn't really the backward-looking story that spooked the market, although there were losses attached to Russia and also to war in Ukraine. But there was also the guidance they gave, the conversation that's taking place around China and what they can do there, and that quite negative coming through from the chairman this morning. Darktrace is an interesting one. This is a cybersecurity business listed in London, up by 8.4%. But really, this is a story linked to Palo Alto and that company reporting after hours. And as that stock surged after hours, so goes Darktrace here in London. The pound is up 0.1% this morning. Not a big move, but I put it in here, Kailey, because we've had some quite conflicting signs at first glance, at least, on the UK consumer. The consumer sentiment numbers out overnight coming in the worst since 1974. So that's nearly 50 years. Consumers have not felt more negative here in the UK. On the slightly more positive side, the retail sales number showed a bit of a pickup compared to expectations, but many people putting that down to people stocking up on supermarket products, on grocery store products, instead of going out because they fear tougher times coming.
Yeah, really that focus on the consumer has been one of the primary stories of this weekend, especially after those retail results we got out of the likes of Target and Walmart. And of course, the week is not yet over. We still have to get through this Friday. So here's a look at what is ahead today. U.S. President Joe Biden is beginning a 4-day trip to South Korea and Japan. Semiconductors really front of the agenda as he visits Asia. Then we're still going to get more earnings out. Deere will be reporting its second quarter results before the market open. And finally, at 10 a.m. New York time, there is a House hearing on building a workforce to navigate the electric vehicle future. Anna?
In China, then, let's get to that top story then, Kailey, as we've both been mentioning it this morning. Banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Let's get more with Bloomberg's Tom McKenzie. And Tom, this does seem to have lifted sentiment, doesn't it? Certainly through the Asia session and to some extent here in Europe as well. It is perhaps well designed, according to our colleagues on the Markets Live blog, but is it going to have a lasting impact given it's trying to counter another policy, which of course is the COVID zero?
Well, these two policies are in conflict, and that is clear. That's the right way to frame it, certainly. The context, the details around this, and Kailey was talking about the 15 basis point cut, which of course came in below the estimates, so a bigger cut and a record cut since 2019 when they reformed this. And the significance is that this goes towards those 5-year loans, which are primarily used for mortgages. So it's targeted at the real estate sector, which of course has faced the dual impacts of the regulatory squeeze, but as you say, the restrictions that we're seeing in cities like Shanghai, COVID zero. So how that plays out is one that we're going to watch, but we know that loan growth has fallen quite dramatically. Fitch, by the way, just coming out in the last few minutes, saying they expect sales out of China, real estate sales, housing sales, to fall between 25 and 30% this year. And for the context, the real estate sector in China makes up about 20% of that country's GDP on some measures. Talking of GDP, interesting that Bloomberg Economics and the team have come out and said they don't expect growth of more than 2% out of China this year. 2% growth out of China. Within the context, that brings us back to levels last seen in 1976. It would also mean that if the team at Bloomberg Economics are correct, you would see the US outpacing China for the first time since 1976, because they forecast the US economy growing 2.8%, China now 2%. The target for the government they've set themselves is around 5.5%. You're expecting, many economists expect them to miss that. Whether we get to 2% is another question, but that would be remarkable with political implications as well.
Bloomberg's Tom McKenzie, always fascinating. Thank you so much. Let's turn now to Bonn, Germany, where G7 finance chiefs have agreed on more than $19 billion in short-term financial aid for Ukraine. German Finance Minister Christian Lindner spoke exclusively with our very own Bloomberg's Maria Tadeo.
We are fundraising to secure the liquidity of the Ukraine government. And it appears that there will be more than 18 billion we can raise to support Ukraine in this crucial historical moment.
Maria Tadeo joins us now from the G7 finance ministers meeting. Maria, what have we learned?
Well, Kriti, I think that essentially he told us exclusively before the communique comes out in a couple hours that they will get to an agreement over the short-term funding for Ukraine. Remember, the Ukrainian government had said over the past couple weeks that they need about 5 to 7 billion on a monthly basis to be able to cover their expenses. This is hard cash for this country that has been torn by the Russian war on the government in Ukraine. Now, Christian Lindner told me that in this communique, there will be a clear pledge from the G7 to put on the table more than 18 billion euros, so about $19 billion, to be able to provide this funding. And he also told me, the way I see it, the Ukrainian government is not going to have any liquidity issues over the long term. Of course, there's a question around the long term and the reconstruction of this country. But if you look at the short term, and that was the concern, the hard cash they need, he says by the end of this G7, that should be solved.
All right, Bloomberg's Maria Tadeo reporting from Bonn, Germany. Thank you so much, and great interview that you had earlier. Now let's head over to Washington. The U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and sent it to President Biden for his signature. Meanwhile, Biden has offered support for Finland and Sweden's bids to join NATO. He met the Finnish president and Swedish prime minister at the White House yesterday, a day after they applied to become members.
This is about the future. It's about a revived NATO that has the tools and resources, the clarity and conviction to defend our shared values and lead the world.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. for more. So, Anne-Marie, what's the next move for the Biden administration and the alliance more broadly?
Well, the president will send this bid and get Congress's approval on it. And then, of course, really the elephant in the room was what Turkey thinks of it. And the president didn't go there, but the Swedish prime minister and Finland's president went there, saying that they hear their concerns of other NATO members and they want to have this open dialogue with Turkey, because we do know that Turkish President Erdogan is trying to block this bid. But many NATO countries, and I was over the weekend with Secretary Blinken at the NATO foreign ministers meeting, and what you heard overwhelmingly is that all of these countries, barring Turkey, really support the bid from these Nordic countries. And President Biden said yesterday that they really have stepped up to meet the NATO requirements and then some. So quite a historic day for the president, because a few hours later he got another win when the Senate approved with overwhelmingly bipartisan support that $40 billion aid package, which means fresh military aid, humanitarian aid, economic aid, and also money to replenish military stocks in the United States will be granted for their use.
He's had a busy time, hasn't he, President Biden? Because now he's over in Asia, Anne-Marie. He's in South Korea. I know that semiconductors and security are going to be a focus. Tell us what that means.
So security on the first part, of course, in the region because of the provocations from North Korea. And if you talk to officials, they are quite concerned that potentially North Korea would actually do some sort of test while the president was in the region. But then, of course, he's going to look at the security of shoring up supply chains. And that is when he's going to be touring just later this afternoon in south of Seoul in a massive complex that Samsung runs for chips. And actually, this complex might mirror what Samsung is building in the United States and Texas. And this is really an opportunity for the president to also point the finger at Congress to get over the finish line, something they've been debating for months, which is a broad-based China competition package, which has some $50 billion to semiconductor research.
All right, thanks as always to Bloomberg's Anne-Marie Horder down in Washington, D.C. for us. Now, one more story we are following today. SpaceX reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. That's according to the online news site Insider. Musk, in a series of tweets, called the accusations utterly untrue. He said that, quote, "The attacks against me should be viewed through a political lens, but that nothing will deter me from fighting for your right to free speech." And of course, that right to free speech is something that he has evoked quite often as he pursues that $44 billion deal for Twitter, although he only really wants to pursue it if bots make up less than 5% of users. And of course, we continue to see Twitter trading under that offer price of $54.20 a share. Interestingly, though, while it does remain below that level, it is actually moving higher in early hours this morning, up about 2.7%. So we're trading around $38.30. And of course, Tesla, Elon Musk's other company, up 2.7% or so in early hours, taking part in a broader rebound we are seeing in some of those high multiple technology stocks this morning. Another stock that is moving higher in a big way is Palo Alto Networks. Anna actually made brief mention of this one. It is a network security firewall company. It reported earnings that topped estimates. Analysts really positive on the billings growth that this company is seeing. That stock up of 11% right now in early hours, but absolutely plunging in the early trade. Ross Stores. Yes, another retailer cutting its profit outlook because of the inflationary pressures these companies in this industry is facing, changing consumer behavior possibly in the face of higher prices. So Ross Stores down 27.5% in early hours this morning, Anna.
Yeah, a fast-changing story when it comes to the global consumer. Well, the US and the UK certainly in focus this week, and we have learnt a lot about both. We will no doubt talk about that and other subjects with Mike Bell, JPMorgan Asset Management Global Market Strategist for EMEA. And we will also be talking to Kamakshya Trivedi, Goldman Sachs co-head of Global Foreign Exchange, Interest Rates and Emerging Markets Strategy Research. Lots to discuss with him coming up shortly, plus the view from Citadel. Billionaire Ken Griffin spoke exclusively to Bloomberg in a wide-ranging interview from the market sell-off to the end of Melvin Capital. The hedge fund is facing irate investors, and Griffin, who helped prop up the fund last year, says he's not going to second-guess Gabe Plotkin's decision.
Gabe was certainly an iconic investor over his career. Over his career, he did an incredible job for his investors. Kudos to him. We all react to adversity in different ways. He went through a really tough run. He chose a decision that worked for him.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. If Matt Miller was here, he would give you some sort of rant about a drawdown, trust me. And this is why I chose this particular chart, because I want to look at the S&P 500 drawdown. Matt would point out that a drawdown traditionally looks at a peak to a trough, but how do you know when the trough actually is if you're right in the middle of it? And that's really what this chart shows you here. For our radio audience, stick with me. We are dropping peak to trough 17.4%. We haven't quite hit that 20% bear market yet. And you'll see the last time that we did goes all the way back to March of 2020. The question here is, now that you're starting to see perhaps a little bit more green on the screen in the last couple of days, flip-flopping from the red, does that signal the market is bottoming out? Let's ask an expert. Ksenia Galushko, Bloomberg's equities team leader, joins us now. Ksenia, let me put that question to you. Are these the signs of the bottom of this potential bear market?
It depends on the signs that you're looking at. So if we look at technical indicators like market breadth, and if we're looking at the 200-week moving average, they do signal that there is more downside from here for U.S. equities, which would bring us to a bear market, 20% a drop from the top in January. At the same time, the valuations are looking quite positive. So the S&P 500 P levels are now trading below the 10-year average. So the froth has come down. The S&P 500 valuations are now the lowest since April 2020. So it could signal buying levels from here. So it depends on which indicators you're looking at the end of the day.
It depends on the indicators. Talk us through where money is flowing to and where it is flowing out of, Ksenia. I know you've been doing some research on money flowing out of various asset classes. I spoke to a guest earlier who was so spooked, he was talking a lot about cash.
Yeah, it's really fascinating. So we got the latest Bank of America and EPFR global data today and the flows. And well, everything is exiting everything. It's really crazy. So both cash funds and bond funds and equity funds and gold funds, also massive outflows in the past week. And actually, some of the few havens that we saw that investors actually put money in were U.S. equity funds, surprisingly speaking, considering the sell-off that we've been seeing, and also U.S. treasuries. So the market dynamics are really quite interesting. It shows that investors are quite spooked. They are fleeing most asset classes, but at the same time, we are starting to see some buying. So for example, in U.S. equities, we saw inflows into real estate and utilities. So more defensive sectors are dominating. And then outflows dominated such value and cyclical sectors as energy, mining, tech continued to see outflows because we've seen this big rout in tech and growth stocks in general. So it's really fascinating numbers.
Yeah, interesting to see those defensives doing well then. Thank you very much, Ksenia, Bloomberg's Ksenia Galushko with us on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That would mark a shift for the president, who has avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. PIMCO and BlackRock are among the firms set to start debt talks with Sri Lanka soon. Bloomberg's learned that AllianceBernstein, T. Rowe Price, and Wellington are also among the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. By one account, the world only has 10 weeks' worth of wheat consumption in reserve, the lowest level since the 2008 financial crisis. That's according to agriculture analysis firm Grow Intelligence. Other estimates aren't as dire, but high crop prices are putting millions at risk while grain supplies fall. And U.S. stock traders are bracing themselves. Today is the monthly expiration of options tied to equities and ETFs. It's an event that is notorious for stirring up volatility. Traders will close old positions for an estimated $1.9 trillion of derivatives while rolling out new exposures. All of this with the S&P 500 on the brink of a bear market. Just what we needed to end a week like this one, Anna.
Absolutely. I was reading earlier, our piece on this said, fasten your seatbelts. I'm not sure we needed that this week, as you say, Kailey. We feel like we've been doing that all week. It's been a volatile ride. Coming up on the programme, we will talk about these markets, where we've been and where we're going. Mike Bell, JPMorgan Asset Management Global Market Strategist, joins us shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Beijing gives the markets a boost. US futures and European stocks are up after Chinese banks slash a key interest rate. China is trying to counter weak loan demand caused by a property slump and COVID lockdowns. Joe Biden is in Asia. His first trip there as president will be dominated by talk of security and semiconductors. His first stop is South Korea. There's speculation that North Korea may conduct its first nuclear test since 2017 while the president is in the region. And more aid for Ukraine. G7 finance ministers agree on $19 billion in assistance for the Ukrainian government. Hours before that, the US Senate gave final approval to a package worth more than $40 billion. I'm Anna Edwards in London with Chrissy Gupta and Kailey Leinz in New York. Matt Miller is off today. And Chrissy, US markets, are they getting a boost from the Chinese sentiment, that crucial or what seemed by some as crucial, at least to short-term market sentiment, cut to some interest rates we got in China? Is that boosting US futures, or does its impact expire with European stocks?
Well, I think you're right in that the initial move is coming from China. But remember, we did close in the red yesterday. So some of this is going to be that natural rebound just in terms of this volatile market. I also want to keep in mind here that you are going to see this big move in futures or potentially the stock market later today, because after all, it is options expiration day. So this green on the screen that you're seeing, 1.2% higher in S&P futures. Anything can happen at the open. Remember, 9:30, 4 p.m. New York time. Those are going to be windows of liquidity for people to kind of come in and really shake out their position. So once again, the green on the screen, it may not last, Anna, but to your point, you are seeing a little bit of a risk on sentiment. Let's call it coming from Asia, for example. 10-year yield also getting a little bit higher here, 3 basis points, 286 on the 10-year yield. Here's where it gets tricky, though. New York crude future down 0.5%, still hovering about a 111 handle, but still a little bit of a risk off sentiment as we talk about the growth picture really happening in the background. Bitcoin as well, down 0.3%, but once again, in a volatility adjusted kind of dynamic, that's actually not that much of a move. So we're going to keep an eye on that in terms of what's coming next for risk sentiment overall, Kailey.
Yeah, still trading around that 30,000 level, which is essentially where we've been trading for the better part of the last 2 weeks. So pretty range bound on Bitcoin at the moment. Now, of course, as Kriti said, futures are positive. It is a move led by technology stocks in particular. We're seeing some of those largest cap tech names outperforming in pre-market trading. The likes of NVIDIA up 3%, Microsoft up about 2%. Very different story, though, as we have seen all week for some of the retailers. Ross, the latest one to come out and cut its profit outlook, dealing with these inflationary forces and an American consumer that is spending more on gas, spending more on food, basic necessities, and that is impacting discretionary spending and their tolerance for higher prices. Creates an issue for retailers trying to exercise pricing power and pass on the higher input costs they are facing. So Ross is down about 28%, and even TJX, which actually lifted its margin guidance yesterday and was a little bit higher on the back of that, is falling in sympathy, down about 3%. Maybe investors having some questions as to how much pricing power they realistically are going to be able to exercise in a macroeconomic environment like this one, Anna.
Yep, let's have a look at the European equity market then. Picture here, Kailey, and we've got European stocks moving higher by 1.5%. The stock 600 then being lifted a little by that more positive message through from China, with everything we've already said about COVID zero policy, etc. This is the share price of Richemont, because most sectors in Europe are in positive territory following that lead. But there is one, and that is consumer products, that is actually falling. And it's the luxury side of that that's really being hit hard today. And this is the Swiss heavyweight Richemont that trades down by 12.4%. Yes, there were some hits to the numbers that they reported from Ukraine and also from China. They've got a number of stores still closed in China, of course, but also it was the guidance they were giving that really weighed on the markets and what they're saying about what they can and can't do over in the Chinese market. Dark Trace, we've talked about this one a little bit. Kailey mentioned the Palo Alto numbers earlier on, and we got a positive surprise after hours from that cybersecurity business, and that is lifting similar companies in similar spaces here in Europe, and Dark Trace in London is one of those. Sticking with London, the pound is fairly flat that right now, as we've got mixed data coming through on the UK consumer, and we've learned a lot about the consumer in the UK and in the United States this week. The UK story today, the weakest sentiment picture from UK consumers since 1974. That is nearly 50 years. But on the other hand, the retail sales number picked up a little. But economists certainly emphasising the former and suggesting that times get tough here, Kailey.
All right, Anna. Well, of course, we also had a pretty big high-profile conversation with one man yesterday, Citadel CEO Ken Griffin. Francine Lacqua spoke with him about the odds of a recession, and he says one is coming, but it's not necessarily imminent. The billionaire spoke to us yesterday.
Yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. We don't know what causes recessions to start. We know the ingredients that create the kindling wood that allows recession to happen, but what actually is the tipping point's often unknown.
Joining us now is Mike Bell, JPMorgan Asset Management Global Market Strategist for EMEA. Mike, great to see you. Obviously, this is a market that now seems dominated by the narrative of a growth scare and the odds of a recession. What have we priced in at this point?
I would say that most markets globally are probably pricing in something like a 50% probability of a recession now. I mean, if you think the average recession probably sees stocks down somewhere in the region of 20 to 30%, and markets are now pricing in, most markets are down about 15% year to date. So I would say that, most markets are priced in at least a 50% probability of a recession. And that's probably about right, given where you see consumer confidence, particularly in Europe and the UK. So the risk from here is two-way. If that recession actually happens, then stocks could potentially fall another 10 to 15% from where we are today. If we avoid recession, perhaps on the back of significant further fiscal stimulus in somewhere like the UK or Europe, then stocks could rally from here.
And what did you take away, Mike? Good morning to you. What did you take away from all that we've learned this week about the global consumer? I say global, I suppose I'm thinking mostly about the US and the UK. We've had data on both fronts and reason to worry on both fronts, do you think?
Yeah, I think that's right. I think that the consumer's under pressure. I think more so in the UK and Europe because they're dealing with the much higher energy bills than is the case in the US. Obviously, in the US, they've got higher oil prices, but they're not seeing the same extent of heating and electricity bills going up. The other thing is we see in the US actually a bit more resilience, I think, because household savings there we think are higher based on our data of the people who bank with us in the US. We can see they're still sitting on quite a lot of savings compared with pre-pandemic. Whereas I think in the UK and Europe, those savings are probably lower because we didn't get the stimulus checks and the people who were furloughed weren't getting quite as generous benefits as the people who were unemployed in the US were during the pandemic. So I think the UK and Europe is more vulnerable. You just look at consumer confidence in the Eurozone and the UK, it's extremely weak. So I think that's why there is that approximately 50% probability of a recession that the market's pricing. I think that's about right. But, it may not happen if governments step in with significant further fiscal stimulus, in which case you could see equities rallying. So I think it's a difficult time at the moment in markets because you've got two-way risk. And so for us, it makes sense to be neutral.
What are you assuming on the fiscal side, Mike? Because there are debates across various parts of Europe talking about fiscal, but some of them are couched in the language that says, well, if we spend too much fiscally, then that starts to play into the inflation push. And even the German finance minister talking about things should be fairly neutral or balanced on the fiscal side.
Yeah, I think in the UK, I think we are going to get more fiscal. It seems highly likely. The kind of political imperative to deliver some more fiscal stimulus seems pretty high. The question really in my mind is it going to be enough? So I think we will see more fiscal stimulus, but with energy bills set to ratchet significantly higher in October, are we going to see moderate further fiscal stimulus or are we going to see really a significant amount that enables particularly the lower half of the income distribution to deal with this squeeze that they're seeing at the moment? And the other thing is what's going to happen to wages, particularly public sector wages. Are we going to see a significant increase in public sector wage growth, which will help them deal with this cost of living squeeze or not? And, ultimately, whether we end up getting a recession, a lot of it's going to come down to what the chancellors in the UK and Europe end up doing over the coming months.
Mike, I feel like the no-brainer trade in this inflationary environment and of the face of very hawkish Federal Reserve is to sell bonds, especially in the U.S. Treasury market. But I have to ask, in the face of this major wall of worry, recession odds, war in Ukraine, you name it, is there a bull case to buy Treasuries?
I think there is, yeah. I mean, I remember coming on Bloomberg back on Valentine's Day in February and saying that it was time to get stocks sort of back down to neutral on the Ukraine risk. The difference between today and then is that Treasury yields and indeed gilt yields have moved significantly higher since then. So I actually think that now I would stick with a neutral positioning on stocks, given the two-way risk and all the uncertainty out there. But I do think it makes sense to, at the very least, be significantly reducing the size of one's underweight positions in duration, given that there's a lot more priced in terms of rate hiking, both in the US and in the UK. And that if we do get that recession risk, then one would expect bond yields to come down, and it's starting to provide a bit more of a hedge to that.
Mike, thanks so much. Thanks for joining us. Mike Bell of JPMorgan Asset Management. Thank you very much for being with us. When we come back, we will talk about what's going on in FX markets and emerging markets. We'll be talking to Kamakshya Trivedi, Goldman Sachs co-head of global FX, interest rates in emerging markets. We'll get to that conversation next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Sycamore Tree Capital Partners CEO and co-founder Mark Okada. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. We've been talking a lot about the equity sell-off. Let's talk about the bond sell-off here, which seems to be in reverse in the last couple of, I want to say in the last couple of days, but arguably I want to say the last 10 days. One of the big questions, though, is if you're starting to see a stronger dollar and yields coming down, that seems to be a disconnect. And that's really what this chart is showing. For our radio audience, stick with me here. You are seeing in this inflationary environment a very hawkish Federal Reserve, yields higher, dollar higher. It means that the interest rate differentials is moving the dollar story as opposed to the haven bid that we've come to know as so associated with the dollar lately. But then you saw this little bit of a divergence. Now yields lower, dollar weakening just a hair. So the question is, which direction is the right direction? Let's ask that to a true expert. Joining us now is Kamakshya Trivedi, Goldman Sachs co-head of global foreign exchange, interest rates, and emerging market strategy research. Really covers the gambit there. Kamakshya, let me put this question to you. Is this the right direction for both yields and the dollar to go to? And if not, is that divergence justified?
Look, I think the key issue here is how close we are to a peak in inflation. I think that is going to be a key determinant of where yields go in the near term, but also where the dollar goes to some extent. And I think that our expectation is that at least in the US, we are getting close, the right sort of ballpark of the financial conditions tightening that is needed, and inflation, core inflation, might be peaking around now. We know that process is messy. You can have months where things are up or down, but by and large, we think we are close to that point. If that is correct, I think it does have implications for yields. Obviously, I think it makes it much harder to be short U.S. rates, given that you are at that peak. For the dollar, that's also important, but for the dollar to really turn down convincingly, you also need the rest of the world to pick up. You also need a sort of better story in other non-dollar currencies. You're getting some of that if the bounce in China continues, if we see some recovery in the data there, if you don't see fresh negative shocks in the euro area. I think that's really the recipe for the dollar to turn down convincingly.
Okay, so what about unnatural forces that may turn down the dollar? There has been at least a conversation happening about a hypothetical scenario in which you see something akin to a 1980s-like Plaza Accord style, where all these countries get together and agree essentially to manipulate the dollar. What is the likelihood you put around something like that happening today?
Well, that kind of conversation comes up periodically when you see, big moves in the dollar, over time. And we have seen a pretty big move in the dollar. The dollar looks pretty overvalued to us across a whole range of currencies. But one important difference is just given how high US inflation is right now, to some extent, a stronger dollar is part of the mix that is required to bring that inflation process down. So, at some level, what is going on in markets, the combination of a strong dollar, wider credit spreads, weaker equities, and higher rates, that is how tightening is meant to work, and that is how inflation is going to come down. So I don't think you'll be seeing a huge amount of pressure or push from the U.S. side to kind of arrest this move too rapidly.
Kamakshya, it's Anna in London. You mentioned how you needed the rest of the world then to step up if the dollar was going to step back. Where does that leave European currencies? I guess I'm thinking in particular, firstly, about the euro. Is a hike in July, is that enough for the euro to put a floor under recent losses?
I think it's probably enough to, keep it roughly stable. I mean, I think that, we expect euro to trade around the 105 type level in 3 months' time. That's our sort of forecast. We think that that's sort of the start of a hiking cycle, and especially getting above that zero level is going to be an important milestone for the euro itself. I think where you can see, real divergence to some extent is versus the UK, versus the pound. I think, the UK has some of the same issues that a lot of global central banks are facing: high inflation, pressure on activity. But the Bank of England's messages have been more attuned towards kind of supporting the growth side of the mandate than the higher inflation part of the mandate, which is effectively, resulting in a weaker currency. So that's a place where we expect more weakness in pound, both versus the euro and versus the dollar.
Kamakshya, you mentioned China and the yuan a few minutes ago. I want to come back to that story because, of course, we saw that 5-year loan prime rate cut, a record cut to that rate overnight. Clearly, Beijing trying to shore up support for the Chinese economy. How much further do they have to go to support the economy and, by extension, the yuan as well?
I think it's important that they are taking measures to support or stimulate the economy. The monetary measures we've seen, and in terms of the rate cut, they've taken measures on the property and the mortgage side in recent days. But I think really the most important measure that can be taken to support the economy, and that will have the biggest impact on Chinese assets, the yuan, but also more importantly, the stocks and local assets, is whether they can get COVID under control. It's very hard to stimulate the economy through monetary measures, through spending measures. You saw the very bad credit data that you got if people are essentially unable to go out and do things or spend or do the infrastructure spending that they want. So I think first and foremost, we need to see COVID under control. If that happens, like almost every other episode of COVID shutdowns that we've seen across the world, I think you'll see a pretty meaningful bounce in the short term in the demand side of things. And I think the measures they're taking on the monetary side would help. But I think the single most important stimulatory measure they can take is get COVID under control.
Kamakshya, thank you very much. Kamakshya Trivedi of Goldman Sachs, thank you for joining us. Coming up in the next hour, more on currencies. Jane Foley, Rabobank's head of FX strategy, she will be picking up that conversation. 6 a.m. in New York, 11 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Purdy Gupta in New York and Anna Edwards in London. Also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, joining us before he jets off to Davos later on this afternoon. Tom, what's on your mind ahead of that trip?
Well, we got two things. The markets are on our mind, and we're seeing a recovery in the markets. John Fair and I will dive into that with Lisa. I think the thing to really watch here is the linkages between the bond market and the stock market on this Friday. The VIX in 28.65 gets my attention. The chart is the first chart at Davos, and I'll be honest, this has crept up on me in that there could have been 3 or 4 charts, but there is no other story is the elite meet to greet in Happy Valley than food prices. This is inflation-adjusted UN food back a good 20 years, and we have launched higher big time. Wheat, U.S. wheat is up 48%. You know, it's just a rough number. But rice is what I'm really watching. And just in the last week, rice, so dominant in Asia, has finally started moving up.
Yeah. Tell us, Tom, a little about the Davos coverage. If food is the focus, I know that the Bank of England governor recently described it as potentially apocalyptic, what we're seeing on food prices.
Yeah, I don't know if it's I can't pronounce it, Ann. I'll let you do it. You know, I didn't get the fine British education. But what I know is my expert on this is Eric Martin, who covers the International Monetary Fund for us. And he's focused on Egypt as a proxy. And, of course, all of that, Anna, alludes back to the Arab Spring of over 10 years ago now, I believe, and what started in Tunisia. So wheat really, really matters, obviously off of Ukraine, but what's to watch? The pros watch rice. Chicago rice is a proxy, and Thailand jasmine is a proxy. That's what I'll be watching on the trip to Davos.
All right, well, we will all be watching you over the next 3 hours. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And of course, we'll be watching the coverage out of Davos as well. As for what else we are watching on this Friday, I will be watching the earnings continuing to roll out. The one I have my eye on today is Deere, of course, the big industrial bellwether company, agricultural equipment. It has been benefiting in a big way as of late by those elevated crop prices that Tom was alluding to. Of course, that's been amplified by Russia's invasion of Ukraine. That leads to strong demand for farm and construction equipment. My question really is going to be, how much are they dealing with the same forces on inflation, on potentially a demand destruction environment in the face of higher prices? What kind of commentary do we get around that? Because as I say, this is a big bellwether company, so definitely something to watch out for, Creepy.
Yeah, Kailey, not just a bellwether company for the United States, but for China as well. Remember, China makes up a good chunk of their earnings as well. But that brings me to what I'm watching. President Biden in Asia for a twofold story. One part of it is going to be those chip shortages, really addressing the concerns, bolstering up the alliances when it comes to South Korea and some of the other supply chains that extend into Asia. The other part of it is going to be really strengthening the Indo-Pacific trade deal, especially as we see China using their economic prowess against some of these major companies. That growing influence, what does that mean for the United States, Anna?
I'm going to be tuning in for a conversation a little bit later on surveillance. Kwasi Kwarteng, who is the UK Business and Energy Secretary, he's going to be speaking on Bloomberg, and this in the context of some data we've had out this week on the labour market, really tight in the UK, inflation running at levels we haven't seen since the early 1980s, at 9% UK inflation right now. Consumer confidence coming in overnight at the lowest in nearly 50 years. The consumer has not felt this gloomy. You have to go back to 1974 to find a time when this happened. And it's interesting when you break this down by age, it is the older age groups who maybe feel they can do the least to protect themselves from this inflation, Kailey, who are feeling the pressure the most. Our colleague Dan Curtis producing good charts on that front. But Kailey, we've learned so much this week about the consumer on both sides of the Atlantic.
Absolutely. That has been highlighted by retail earnings, not just from the likes of Target and Walmart, but even Ross Stores overnight. A lot of retailers cutting their profit outlook as a question on the health of the consumer and the pricing power that they face. Of course, that wraps it up for Early Edition with Creedy, Anna, and myself. Surveillance is ahead with Tom, John, and Lisa. Happy Friday, everyone. This is Bloomberg.